Now we will go through each type of the derivative, forward contract, future contract, option and swap to have a general feeling about this kind of derivative to understand the main characteristic, the main distinction between them. Let's start with the forward contract. Basically, a forward contract is the easiest form of the derivative. For example, you and I, right? We enter to the agreement either to buy or sell something at the future date at the fixed price agreed today. All right. So the key word here is that there is the agreement between two parties. Always there are two sides of the trade, the buyer and the seller. All right. And we will agree to buy or sell something at the future date, not today, but sometime in the future, at the price fixed. Okay, the price will not change. We will fix the price today, but only pay in the future. And that fixed price will be agreed between two parties today. And the fixed price is so-called the forward price. Okay. So generally, the forward are used to mitigate the price movement risk by locking the price today for the transaction that occur in the future. So that is the definition of forward contract. So what is the most distinction between forward and future contract? Forward and future contract are very similar, but the main distinction between them is that the forward contract, they are not standardized. They only customize to cater the needs of both parties entering into the contract. What does that mean? What does that mean by customize? Customize means that it's like when you can design the contract exactly the way you want. When you buy it, where you want it to be delivered, when you want it to be delivered, and what the price. Those conditions, those terms in the contract are exactly tailor-made, not standardized. Okay, it will depend on the need of each side of the trade. Very simple example of forward contract is that people, they can get together. For example, you come to me and you say, hi Thảo, I like your financial calculator, but I won't need it until the next semester. So I will pay you $100 for the calculator in 7 months, okay, when the next semester starts. And then we can enter into the contract. Under the contract, I agree to sell my calculator in 7 months, and you agree to buy it in 7 months at $100. Okay, so with this example, the contract specifies the underlying asset. The underlying asset in this example is the financial calculator, right? And the settlement day will be the first day of the next semester. I only deliver the calculator to you on the first day of the next semester, right? The maturity date of the contract will be 7 months from now, when the next semester starts. And the quantity of the contract is one calculator, and the forward price is the fixed price we agreed today, which is $100. It is a simple example for you to understand how the forward contract works. Okay. The second characteristic, forward contract that are typically traded in the over-the-counter market. What does that mean? This means that there will be no recourse. So if the financial calculator has serious quality issue later, you cannot come back to me and ask for the compensation. All right? Next semester, you could have a financial problem and you bankrupt. You're unable to pay 100. That is the risk of the default. Okay? There is the credit risk in this case. Obviously, the transaction is essentially unregulated. It is the private transaction. So it has a higher credit risk. And the second disadvantage is that because it is customized, therefore it may be difficult to find a counterparty to enter into the contract. It is the private contract, so there is less of liquidity. Because this kind of contract is customized, right? So it's hard to find the counterparty who will willing to enter into the contract. Because of the lack of liquidity and it's hard to find the counterparty to trade, the people, they come up with the future contracts. They think, why don't we standardize the contract? In that way, there will be more liquidity for the secondary market. If you want to sell the contract, you're easy to find somebody to enter to the contract, right? More liquidity if we can standardize the contract. And the standardization, that is the most distinction between forward contract and future contract. The second difference is that the forward is traded on the OTC market, while the futures is exclusively traded on the derivative exchange. Okay, so it's subject to the higher regulation. So exchange is provide more liquidity, But there will be the cost, there will be the trade-off in terms of flexibility. Because all the contracts, they are standardized, right? So it will make it very difficult for the participant to get exactly what they want, even though they can get close substitute. So what else about the feature of the future contract? With the future contract, the exchange will provide the mechanism known as the clearinghouse. And with the help of the clearinghouse, the two parties to the contract, they do not necessarily know each other. Alright, so clearinghouse will give the two parties a guarantee that the contract will be honored. Suppose that I'm a farmer and I'm growing corn. I want to sell my corn, so I write a contract with the clearinghouse, and the clearinghouse will then write the contract with the person who wants to buy my corn. Okay, I don't really need to find somebody on the other end of the transaction. The clearinghouse will help me to find another side of the trade. Okay, so you can think it as some kind of the middleman, all right, between two parties, the buyer and the seller. The party who entered to the future contract, they will know that there's liquidity in there and there's substantially less credit risk. And in fact, sometimes there's no credit risk, because the risk that either party might default is guaranteed against by the clearinghouse. Okay, and how can the clearinghouse guarantee against the default risk? Because of the daily settlement process. Okay, this is the most important distinctive characteristic of future contract from the forward contract. For forward contract, there is no daily settlement process. There is no mark-to-market process. But for the future contract, the gain and losses will be settled daily. You will learn this in more detail in the next topic. Then the next question is, when would investor refer a forward contract to future contract? And when would he refer a future contract to forward contract? Which one should we choose, forward or future contract? It depends, right? So basically, the choice is a matter of taste and reference and constraints. For example, if you want to write a contract on the asset that have the delivery date and the contract side that is easily to accommodate it by the exchange, then you should go for the future contract. Because with the future contract, you will have more liquidity, right? But if sometimes you need to write a contract on the asset that is not easily accommodated by the exchange, then you have no choice but go with the forward contract. And in this case, the forward contract will be more appealing because it gives you the flexibility to tailor the contract in the way you want, right? On the other hand, if liquidity is more important factor for you, then you may refer the future contract. So it totally depends on the reference and the constraint of each trader, alright? Remember, in the forward contract or future contract, or even the swap contract we go into discuss very shortly, whether we check along on the short position, we are obligated to do something. Okay, so when we talk about future forward or swap contract, it is about the obligation. But for the option contract, it is quite different. It's unique in the way that the owner of the option has the right, but not the obligation. And therefore, when you buy the option, it gives you the right, and you need to pay a substantial premium for this right. For the forward or future contract, you don't need to pay anything when you first create the contract. No money exchange hand at the initiation. Okay, but for option, when you buy option, one party will need to pay another party the premium, or it is so-called the price of the option. Now let's go ahead and get right to the definition of the option. The buyer of the option has the right but not the obligation to buy or sell the underlying asset at the fixed price agreed today at a predetermined time in the future. Okay, so you can see the definition is very similar to forward and future contract. The only difference here is the keyword, the right but not obligation. There are two types of option. We got the put option, okay, and the call option. So the put option, it gives us the right to sell something, okay, and the call option will give us the right to buy something. For example, I buy the put option, it means that I will buy the right to sell the financial calculator at $100 in 7 months from now. And if I buy the call option, it means that I buy the right to buy a financial calculator in the future. Okay. We also have two kinds of the option. It is so-called the American option and European option. So does that mean the American option are traded in America and European traded in Europe? These names, they have nothing to do with where these options are traded. Both types of the option, they are traded on all continents. Okay? So basically, the American option will give you the right to exercise the option early. Okay? Early, it means that you can exercise anytime before the expiration or on the expiration date. Let's say if I buy the American call option, then I have the right to buy the financial calculator anytime before the expiration date, anytime before the next semester start. I can buy it tomorrow, in 3 days time, or in 1 month time, or on the expiration when the next semester start. Okay, so American option give you the right to exercise early anytime before the expiration. And for the European option, it means that you have a right, so you can only exercise at time T, expiration date. Okay, if I buy the European call option, it means that I only have the right to buy the financial calculator in 7 months from now when the semester starts. Alright, at the expiration date only. And for American, I can buy it early, anytime I want. So you can see that here we got put and call option, American and European style. So it means that there are the different combinations. We will have the American put option, American call option, or European put option, or European call option. Now we look at the option terminology. Similar to other instruments, there are always two sides of the trade and no exception for the options. So we can see that there are two sides in the option contract. One side is so-called the option holder or option buyer. Okay. Another side we have the option seller or writer. One side buy the option, another side sell the option. The buyer of the option will pay the option price. Let's say I will pay you $3 so that I can have the right to buy the financial calculator at $100 in 7 months, okay, when the next semester starts. Okay? And in exchange, you need to give me the right. Okay? So I will have the right to buy it or not. After 7 months, I can choose to not buy it, or I can choose to buy it at $100. Okay? So the holder of the option will have the right to choose to exercise or not, and the seller of the option will have the obligation to fulfill that choice. $3 here, it is so-called the option premium, or just the premium. It represents the fair price of the option. And in the well-functioning market, it would be the value of the option. Under the contract, I will have the right to buy at $100. So this is so-called the premium, and this is so-called the exercise price, or the strike price. Okay. Now, what happens if the expiration date, let's say after 7 months, the spot price of the market price of the financial calculator is increased to 110? What would I do? Should I exercise the option or not? Of course, I will choose to exercise the option, right? Because if I exercise the option, I can buy the financial calculator at 100. If I buy in the market, I need to pay 110. So I will choose to exercise the option, and I can pay a cheaper price for the same financial calculator that are sold in the market at the higher price. Okay, so that is the gain for me. And when I choose to exercise the option, I choose to buy it for $100 after 7 months, then the seller of the option will have the obligation to sell it to me at $100, right? What if after 7 months, the price will drop to 90? It will go in another direction than what I would expect then should I exercise the option or not? I will let the option expire and walk away. Why? Because if I walk away, I only lose $3 here, the amount of money I pay at the beginning, and then I can go to the spot market and buy it at $90, right? Much cheaper price than I buy it through the option contract. Okay, so if the price decrease and less than the strike price, then I will let the option expire and walk away. And I will buy the financial market directly from the spot market. How about the seller of the option? Because I choose to not exercise the option, then the seller do not need to do anything. He can keep this amount of money for himself without doing anything. He don't need to sell the financial calculator to me because I choose to not exercise the option. Okay, so can you see that for the option, it gives you the right. Okay, one side have the right, another side had the obligation to fulfill that right. But for the forward or future contract, both sides will have the same obligation. Okay. The next question is how option different from forward and future contract and how are they similar? If we look at the definition, we can see that they are both financial contract that exists between two parties, right? The buyer and the seller of the underlying asset. And under the contract, one party agreed to buy or sell something at the future date at the fixed price determined today to another party. So the definition is very, very similar. The fundamental difference between the option and futures is in the obligation of the party involved. You can see in the forward and futures, both parties, they are equally obligated to the contract. They have the obligation to fulfill the contract. All right? Because they do not need to pay anything at the beginning. They are equally obligated. But for the option contract, one party will pay another party the premium at the beginning. Therefore, the holder of the option contract has the right, not the obligation, to buy or sell the asset in the future. And if the holders choose to exercise the option, then the seller will have obligation to sell or buy the underlying asset as promised in the contract. Okay, so you can see that because of this characteristic, this is obviously put the holder of the contract at the advantage. From my previous example, you can see if the price of financial calculator moves against me, then I can simply let the contract expire and not incur any losses over the premium I already paid, $3. If the financial calculator price is moved in the right direction for me, right, the price increase, then I can just exercise the option. I can buy it at a cheaper price compared to the market price. And when I choose to exercise the option, the writer must honor their obligation. How about the market, where the option can be traded, OTC market or the exchange market? For the future, it is traded in the exchange market. For the forward, they are traded in the over-counter market. For option, you can trade the option in both markets. It can be customized to the term of the each party and traded in the OTC market, or it can be also created and traded on the option exchange and standardized. All right, so they will be traded in both markets. That's the difference between the option, forward, and future. And remember that another important distinction is that for option, because you get the right, therefore you need to pay the premium. But for forward and future, no money exchange hand at the beginning. Okay, because two parties, they are equally obligated. So no need to pay any money from one party to another party at the initiation. Another fundamental difference between the use of forward contract, future contract, and option is that for future and forwards, they are mainly used when you want to lock in the price today. Okay, but for option, it is more like buying the insurance. You buy the option, you pay the premium, then you will receive the protection from the adverse movements of the asset price. The final type of derivative we're going to cover is swap. For example, someday you have an iPhone and your friend has a Galaxy Note, and you said in your mind that you would like to give up your phone and swap with your friend's Galaxy Note. So you look at somebody's position and you want to give up your position, you want to swap with someone else's position. Okay, that is the nature of the swap. Of course, we're not swapping the phone in the derivative market, But in the context of derivative market, we go into swap the interest rate or the commodity or the currency, or we can even swap the return on the different equity or the stock index. Okay, swap contracts are really cool. Swap are relatively young financial instruments. They have been created only in the early of 1980s. However, you will be surprising to learn that the swap is most widely used derivative. That may be the result of its simplicity. It's very suitable in many scenarios in the corporate world. Okay. So what is the main characteristic or the definition of swap? A swap is a contract in which two parties agree to exchange a series of cash flow. So basically, the swap contract you can compare best to the forward contract. But forward contract, it has only single payment at the maturity. However, swap will typically involve a series of payments in the future. So you can say the swap can be viewed as a combination of multiple forward contracts at different maturity. The swap also similar to forward contract in the way that it is also traded in the OTC market. Okay, it is privately negotiated and subject to default. That's the main key characteristic of the swap. In this slide, we go in to talk about the ways that derivative can be used in the market. So basically, there are three broad categories of trader can be identified in the derivative market. We have hedgers, the speculator, and the arbitrageurs. So the three relevant concepts will be hedging, speculation, and arbitrage. Okay, so I use the three pictures to represent each type of trader respectively. First of all, let's look at the two concepts, hedging and speculation first. So what does that mean by hedging and what does that mean by speculation? Are they similar or are they different? Alright, we focus on hedging first. So why do people want to hedge? Because they want to reduce risk. Okay, the market participant who use the derivative to reduce risk is so-called hedger. And hedger are the risk averse. Okay, they do not like risk and they want to reduce risk. So the best way to understand hedging is to think of it as a form of insurance. Similar to when you buy the insurance for your house, right? You want to insuring yourself against a negative event happen to your house, right? So when you buy the insurance, of course, it doesn't prevent all negative event from happening. But if something does happen and you properly hedge, then the impact of the event is reduced. Okay, that is about hedging. So the purpose of hedging is to reduce risk. The next question is how to hedge. Hedging is in order to eliminate the volatility associated with the price of the underlying asset. Therefore, to reduce the volatility, to reduce the uncertainty, the hedger, they will take the opposite position contrary to what he currently has in the spot market. Okay, let's look at this example. For example, you own the share of Southwest Airlines. Okay, so you own the share, it means that you got the long position in Southwest Airlines share. Okay, and currently the stock price is $40 per share. All right, suppose it is $40 per share. Although you believe in the company for a long run, but you're very worried about the short-term losses in the airline industry due to the whole travel restriction since the COVID pandemic, right? So the share in the airline industry have been especially hard hit because of the travel bans around the world, right? To protect yourself from a fall in the Southwest Airlines shares, you can do the opposite position to what you have in the spot market. This is the position in the spot market. All right. Then in the derivative market, you can take the opposite position. So you got two options. You can short the future contract, okay, or you can buy put option, for example. Okay, let's say we will buy the put option. Then what happened? So when you buy the put option, the exercise price equal to $40, for example. It means that you pay the premium amount to the seller of the put option, and the seller will give you the right to sell the share at $40 in 4 months. for example. Okay, so let's say in 4 months the stock price will drop to $30. Then what is the payoff in your spot market position? You will have loss or gains. Of course, you will have loss because initially the value of the portfolio is 40, but now it's only 30 per share, right? Then the loss is $10. But if you look at the derivative market, the payoff we already discussed how to calculate the payoff of option in the previous slide, right? So the payoff here is just equal to 40 minus 30, and then you will have the gain of $10, right? Because you have the right to sell it at $40 and it's only worth $30 in the market. So it means that you can sell it at a higher price and $10 difference realized as your gain. Okay, so you can see that the loss in the spot market will be made up by the gain in the derivative market. Okay, by taking the opposite position, then you can offset the loss somehow. Alright, so whatever you make or lose in the spot market, you can make up in the derivative market. Okay, so derivative is used to offset the risk of any adverse price movements. That's the very basic example about hedging. Okay, so remember that the goal of hedging, it isn't to make money, but the main purpose is to protect from the loss. Okay, how about speculation? So if you buy or sell the futures or you use the derivative without having any business related to the contract you are buying or selling, let's say you do not hold the Southwest Airlines stock, but you still buy put option or you sell the future contract, right? You use the derivative on the asset that you do not own in the spot market. This is so-called speculation. So the main purpose of speculation is to profit from betting on the direction in which the asset will be moving. Okay, so you are betting that the price of the assets will go up or go down, and if it's moved with your expectation is correct, then the gain will be made. All right, that is the speculation. So the speculator, they are the risk lover, right? They want to increase risk so that they can increase the profit. That's the difference between the speculation and hedging. One side is the risk adverse, want to reduce risk. Another side is the risk lover, want to increase risk. So speculator, they trade based on their educated guesses on where they believe the markets will be in the future. All right. So speculators are very vulnerable to both downside and upside of the market. Therefore, speculation can be extremely risky. Okay, so by now you should understand the differences between the hedgers and the speculator. Basically, in summary, the hedgers use the future and forward and option to reduce the risk that they are faced from the potential future movements of the underlying asset they are holding in the spot market. On the other hand, the speculators use the derivative to bet on the future direction of the market variable. Okay. So that's the main differences between the hedger and the speculator, or hedging and speculation. How about arbitrager? Arbitragers are the trader who take advantage of the discrepancy between the pricing in the two different markets. For example, let's say this textbook, right? It is sold at the RMIT bookstore at $200, but exactly the same textbook sold at the Melbourne Uni at $210. So there will be the discrepancy between the prices of the same textbook in two different markets. And in this case, if the trader can recognize this discrepancy, then he can buy low and sell high to earn the profit. He can buy the textbook at the RMIT at 200 and sell it at Melbourne Uni at 210 to earn $10 profit. This is so-called the arbitrage opportunity. Okay, arbitrage is riskless and no risk involved. For arbitrage, you will have the certain positive payoff without the risk of loss, because you just buy low and sell high and you earn the profit immediately. Okay. However, please bear in mind that the arbitrage opportunity can exist, but only on a temporary basis. Okay. They will be quickly exploited and bringing the price back in line with each other. So let's say there is a difference between two prices, 200 and 210, but then many people recognize this opportunity. They try to buy low and sell high. Then the price in the lower market will be pushed up, and the price in the higher market will be pushed down until it converge and go back in line and converge into the same price. So arbitrage opportunities will exist just very short time, okay, due to the law of one price. Okay, so now we already go through the very important concept that related to the derivative market. Now we will discuss a very important question. The equity and other fundamental market, they exist and usually perform reasonably well, right, without derivative market. So the question is, why do we still need derivative market? What is the purpose the derivative market serve for the financial market? Okay, to answer this question, we should look at the role of financial derivative market. We should look at what are the benefits derivative market offer to the financial market. All right. So the first benefit of derivative market, it is risk management. All right. As previously mentioned, the ultimate objective of using derivative is to hedge risk, right? To set the risk to an acceptable level. So basically, derivative can be used to set the risk to the acceptance level. So you can see that the hedger, they are seen as the risk averse, and the speculator, they are typically seen as the risk lover, right? So hedger try to reduce the risk, and speculator try to increase the risk. So it means that the hedger risk must be assumed by the speculator, okay? Or you can put it this way, derivative market will enable the investor who want to reduce risk, transfer the risk to those wanting to increase risk. Okay, so it will have to transfer the risk from the hedger to the speculator. So this is so-called the risk allocation. And because of the risk allocation, all investor, they can set the risk to the acceptable level for them, right? So they don't need to assume any uncomfortable level of risk. Okay, now we talk about the price discovery. When you buy a future contract, you will set the price today, right? And the price today you set in the future, it will reflect your expectation about the future price of the underlying asset. Is that correct? Let's say you agree to buy the financial calculator 4 months from now at $100 because you believe that the market price of financial calculator going to increase in the future, right? So basically, the future price or the forward price, it will contain some useful information about the market value of the spot. Okay? Because it contains some information, we can think that the future price is sometimes thought as the predictive. And in this way, we can conclude that future and forward contract provide the price discovery. Price discovery means that it contains some useful information about the price in the spot market. Next one, we talk about the operational advantages. When we talk about the operational advantages, it means that we talk about three aspects: transaction cost, liquidity, and the ease of short selling. Okay, so we will compare with the spot market. We compare with the stock market. All right, so the derivative will offer the lower transaction cost because it provides the risk allocation and more participants will engage in the trade. Therefore, the transaction cost will be lower compared to the stock market, right? In terms of the liquidity, derivative market will offer greater liquidity compared to the spot market. The investor, they can set the level of risk to their acceptable level. Therefore, they're willing to trade more. When more participants in the market, of course, the liquidity will increase. And finally, the derivative will allow the investor to sell short easily compared to the spot market. All right, so it's always much more difficult to go short than go long in the spot market, and in fact, for many commodities, the short selling is nearly impossible. But in the derivative market, short selling is very popular. All right, last one is the market efficiency. So when we take all things together, the derivative market offer you lower transaction costs, higher liquidity, short selling easier, and also less capital is required, and all of these benefits will make the market more efficient, right? Investor will be more willing to trade, more market participant, then more liquidity, and the very liquid market may not automatically be an efficient market, but it certainly has a better chance to be an efficient market. Now we go into conclude the lectures by discuss about the derivatives mishap, what is the criticism about the derivative, and what we can learn from them. All right. From this slide and the next slide, you will see that the mixed use of the derivative products have created million or even billion of losses for many companies. The biggest losses can be made by the financial institution, or it can also made by the non-financial organization. And what is remarkable about this list is that there is a number of situations where the huge losses arose from the activities from the trading of the single employee or from the individual trader. Okay. So the list is quite long and we don't have enough time for this lecture to cover all of the example. So you can see that at the bottom of the slide, we have the YouTube link, and this link will direct you to the simple and the very short story of the credit crisis. It explains about the causes of the financial crisis, global financial crisis in 2008. I can say that it's very interesting video to watch and easy to understand. And if you want to find out about the other event, the other losses by financial institution and non-financial institution in this list, you can easily do a Google search. The comprehensive story will be available online. Okay, so beside the benefit of derivative market, we have discussed the huge losses experienced from the use of derivative have highlighted two main criticisms of the derivative product. What are they? The first argument is that the speculation is considered more or less just a form of gambling. Do you agree the derivative is just a form of legal gambling? This is true and also not true. Okay, so why it is true? Because speculators are often thought to be a short-term trader. They attempt to exploit the temporary inefficiency, so they care little about the long-term fundamental value. They just try to make profit. Okay, so usually they will engage in price manipulation and they try at the extreme price. And all of this kind of trading can be viewed more or less just the form of legalized and uncontrolled gambling. Okay, it can be very risky. The second criticism of derivative is that speculation can destabilize the financial system. It can increase the systematic risk. How? Derivative, by the way they are traded, they are certainly be more risky compared to other type of investment, for example, stock or bond, right? So derivatives are more often highly leveraged because of more relaxed regulation surrounding them, right? The speculator, they can use a large amount of leverage, and when the level of leverage is high, then they can trigger the default, higher chance of default. Right? Default by speculator can then lead to the default by their creditor, and their creditors of creditors, and so on. This can harm the economy and can increase significantly the systematic risk. Right? The very good example are the long-term capital management hedge fund crisis in 1998 and the GFC in 2008. Okay, so these crises, they are the result of excessive speculation. When the people, they misuse the derivatives. Too much leverage, too much speculation, and it leads to the higher systematic risk in the economy, and it triggers the default of many large organizations in the world, and that leads to the crisis. So derivative, it may seem dangerous if they are misused, but it also offers a lot of benefit. As long as we make all the derivative transactions more transparency, and also we increase the regulation surrounding the use of derivative, it can offer a very great benefit to the economy. Okay, now let's talk about the lessons for all users of the derivatives. So based on the bad experience from the past regarding the misuse of derivative, it is essential that all companies should define a very clear limit to the financial risk that can be taken. Okay, so the first lesson is that the risk must be quantified and set a limit. The second lesson is about the exceeding risk limit. Okay, so it should not be acceptable for anyone to exceed the risk limit, even when the profit result. So sometimes you ask the question, what happens if you exceed the risk limit and you make a very good profit? So that's a good thing, right? Actually, this is the very tricky question for the manager. It is so tempting to ignore the violation of risk limit when you earn a lot of return. However, this is just a short-sighted because this will lead to the culture where the risk limit are not taken seriously. And what if everyone just break the rule, right? Break the limit? Then you will come down with the disaster. Okay, maybe the bankruptcy. And then the next lesson is that we should not assume the trader with a good track record will always be right. What does that mean? Of course, some traders they are better than others, right? But no trader get it right all the time. So some people they got a good track record of trading, but it doesn't mean that they always be right. Okay, that's a very interesting question to bear in mind. And the next is that you should make sure that your portfolio is well diversified. If you diversify your portfolio with the different asset classes, then you can reduce a significant level of risk. Last but not least, the risk management strategy always should include the scenario analysis and the stress testing. Okay, so we will talk about this thing, scenario analysis, about the stress testing when we look at the value at risk topic. All right. Okay, and in the following slide, we have the lessons for the non-financial corporations beside the financial institution. I will leave it for you guys to read the chapter 25 of the textbook and to find out more about these lessons due to the time constraint of this lecture. Okay. And the next week topic will be the interest rate risk. I hope that you guys will spend some time in this week to review the concept of time value of money because that concept is very important and crucial for you to understand the next topic, topic number 2. Okay, remember that this week we don't have tutorial and the first tutorial will start in week 2. That's all for this topic. Today we have learned about the different type of derivative, their main distinction, and look at some simple examples. We also cover some core concepts related to the derivative market. And finally, we look at the benefit and criticism of the derivative market. Okay? So what did you think about this topic? Alright, so that's all for today. I hope the lecture today helped you clear things and make you feel interested to know more about derivative. I know some of you may be living in or near the hotspot area, so please take care of yourself and your loved ones. Thank you very much for watching this video. See you in the interactive section and the next video. Bye!